So some of your money is then earned sort of effectively tax-free, which is good for you as an investor. And also, if you have capital losses, you can carry them forward to set against other future capital gains. So this is good for tax purposes. And also dividends have this other dividend tax credit as well. So this gets more into personal financial planning. Is how do you want to earn your income? And usually you try to avoid a lot of interest income because that's usually the highest taxed. Okay, so that's why investors like capital gains. Is usually some of it can be earned tax-free. I believe it's 50% if I remember correctly. But they change these rules because they're from time to time. But I think right now it's at 50%. So what that means is if you have $100 in capital gains, they treat that as if you only had $50 in income. So $50, in other words, you get to keep tax-free, which is great. And also, you of course want your initial principal back too if you sell your shares. You don't want the price of your stock to fall below what you paid for it. And lastly, this is my last slide in this series, is the importance of rounds. Drop my pen here. Basically, investors don't want to say, okay, hello, Mr. Entrepreneur, you want some money, here's $20 million, go to town. That's normally not done. It usually comes in rounds and stages. So for instance, in this one book here, for instance, they divide it into 3 stages, like early stage financing versus, that's stage 1. Stage 2 is expansion financing or development financing. And then the last stage they call acquisition or leveraged buyout financing. And this basically, what this is basically doing is, the reason they have the different rounds, so to speak, and those rounds, by the way, can be broken down into more rounds. Like for instance, the early stage financing could be broken down to what they call seed capital and startup capital, are corresponding to basically the life cycle of the company. So seed capital, which is the very first one, for instance, in this one, is a small amount of money just to pay for doing a feasibility study or proving the concept. Whereas, let's say, a later stage, right? So, for instance, what they call third stage financing, which is part of the sort of expansion and development, you're talking about the company is trying to finance a major expansion with rapid sales, right? And you're now at your break-even point, so your sales are covering your costs. Whereas earlier stages, your sales aren't high enough to cover your costs, so that financing is then to sort of make up the difference. And then, of course, the last stages are basically now you're selling off the company, which has proven itself making lots of sales, very profitable, very attractive, right? So that's sort of the gist of it. Is that what kind of financing you go ask for changes with the sort of situation of the business, right? It's very situational, basically. It's contingent upon the situation. Okay. The other reason, of course, is it helps motivate the entrepreneur. By setting these milestones, there is these theories about how to motivate. I think they call it the punctuated equilibrium theory, I believe is what it's called, if I remember correctly. Is that people tend to if let's say you give them 10 days, and you say, okay, I want this project done in 10 days. The first 5 days, the first half of the time, they're not working too hard. When they hit that middle point, and then their work goes up. They start becoming much more productive. So by creating a whole bunch of milestones, we're getting people spending more of their time working at a higher, more productive level, right? Because the investor wants the entrepreneur to be working very hard, because if they're working harder, they can create more sales, and that pushes up the price of their stock, or it generates more sales, so therefore their bonds, their debt, are more secure, right? The other thing, of course, is information asymmetry, effectively. Right? If you're a banker and this is some new guy coming and borrowing some money, you don't know whether this person, let's say, has no track record, So you give them a small amount of money to sort of test them out. It's like giving them a test drive. See how they behave. Are they going to make all their monthly payments? Are they committed to the company, and so on. And then if as you learn more about them, then you might be more comfortable and trust them more to lend them more. That's sort of the idea as well. So maybe the first round you give them a couple $1,000 test run. And then as you build more trust, as they build more of the relationship between the entrepreneur and the people funding the company, then you might want to lend more. And that's pretty much it. So this concludes my this series, and hopefully I can get this to work. Oh no, that's not it. It's Control Shift